Hi there and welcome back to Money Managers, a User's Guide. I'm Nathan Peters. Thanks for bearing with the lack of content last week as I was away for the long bank holiday weekend and enjoying some much needed sunshine. But this week there has been some news in active and activist management that I couldn't let go by without examining the issues a little more closely. Yes, I'm talking about Asset Value Investors, or AVI's, bold approach to the board of Third Point Investors Limited, TPIL, which is a closed-end feeder vehicle to Third Point's main hedge fund. The feeder is listed on the London Stock Exchange. I'll put the tickers and websites of the entities in question in the description box below. Now, AVI has a long and successful track record of activism and engagement. But I'm sorry, AVI, you've got nothing on Third Point's founder, Dan Loeb. I put the two track records side by side here in Venn as a backdrop. Both show good alpha and returns, but during the common period from 2007, Third Point dominates, even with a persistent 17% discount to NAV, which is the reason for AVI's umbrage in the first place. If we look down, factor exposures, Third Point has a bit more beta to small cap, less equity exposure, about 0.4 versus 0.9 for AVI, a bit more emerging markets exposure for Third Point, and obviously credit exposure, given that Third Point has been active in credit strategies. Alpha risk dominates the Third Point book, while it's only a third of AVI's book. And the return here, annualized since inception of Third Point, from Alpha, is 9%, over 9%, whereas AVI's is about 4.8%. If we plot that in cumulative residual return terms, the chart looks like this. Blowing off steam here post-pandemic for Third Point, whereas AVI a bit more muted. Before we dig in, a little history yields good context here. When I was just starting in the industry, I vividly remember Dan Loeb's writerly prowess and withering public put-downs of the behavior of corporate elites around the world. He was by far the most feared activist in the knots, and as his firm has grown and diversified, he's mellowed into different strategies and a more constructivist approach to unlocking shareholder value. However, according to AVI's recent letter of the 26th of May, link in the description below, he still has that fire within. Now here's a quote which AVI must have recorded from a webinar in February, as it had been subsequently redacted from the official record. And this is Dan Loeb speaking. Look, if I thought the company was badly managed, meaning Third Point, you could certainly try to vote me out and move the management of the fund to someone that you think is a better manager. But you certainly knew also what the corporate governance of the entity was before you buy their shares. So I wouldn't suggest doing that on a company that has a dual share classes or the kind of voting protection that we had, which was put in place specifically to protect our long-term investors from short-term profiteers who are looking to make a quick buck by trying to liquidate or diminish the amount of capital that we have invested. What we won't do is sacrifice the long-term value of this entity and its ability to make investments and to allocate capital to, satisfy the short-term desires of a few shareholders that are just seeking to earn a quick buck by trying to bully or force the board or me to do something that isn't in the long-term interest of all of our investors. It's a very small-minded way to invest if you are just going to game the system. Try to make quick bucks on things like this, and it might be the best thing for them to move on and find other companies to invest in. This is just delicious, and it reaffirms Dan Loeb's status as the Kanye West of Wall Street. Crazy, insecure, despite enormous success and celebrity, as described in William Cohen's Vanity Fair article from 2013. Now, you can say that closed-ended trusts always have this NAV discount issue, and that Dan Loeb is just trying to maximize long-term value, as the entire world seeks greater opportunities in private markets these days. But post-Woodford, the UK investor is likely to take a very dim view of any attempt to make more illiquid something already trading at a discount. I can honestly see both sides here. Maybe therein lies a nugget we can take away from this episode. TPIL was formed in the pre-GFC heydays in order to raise permanent capital for the hedge fund well before it considered expanding into a current 17% position in structured credit and 8% in privates, of which 7% are level 3 assets. Perhaps TPIL as a permanent capital vehicle has gotten a little long in the tooth, and Third Point needs to shed its corporate skin before it continues merrily unhinging its jaw and swallowing whole woodland creatures like it did with Grab, Upstart Holdings, and Social Finance. If Dan Loeb wanted to raise a 10-year lock VC private equity fund, I don't think he'd have too much trouble replacing the $860 million invested in TPIL. And the great thing is, with these public battles, we all have front row seats as it plays out. Well, thanks for making it this far with me on Money Managers, a User's Guide. If you enjoy this content, please like, subscribe, comment, and hit the bell for notifications of future episodes. Thanks again.